Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review where I talk about current events for the everyday investor and home buyer. So first of all, hot off the press, we have a coalition agreement in place. So a new government is about to step in, and some good news for property investors. So details are a little bit light at the moment, but Chris Bishop's going to be the Minister of Housing, and some of the information that was updated in the press release this morning was that, first of all, it looks as if ACT was able to negotiate earlier introduction of the interest deductibility for mortgages, as opposed to National's original idea of phasing that in over the next few years. So that's great news for investors. The other good news for investors that was announced in today's press conference was that there'll be a pet bond able to be introduced, which has previously not been allowed to be introduced as part of the tenancy agreement. And I think that's a great thing for tenants, as well as gives landlords a bit of extra protection as well, just in case the tenants' pets cause a bit of damage. So great news all round, in my opinion. All right, so topics for this week. First up from Stuff on the 22nd of November, relief may be in sight for interest rates. Second topic from landlords.co.nz on the 21st of November, solving the rental shortage, new legislation and a change of attitude. Topic number 3 from One News on the 23rd of November, rental growth surges to double long-term average, CoreLogic. Fourth topic from Stuff on the 23rd of November, here's where demand is rising fastest for houses. And topic number 5 from One Roof on the 22nd of November, Tony Alexander, 119,000 reasons for an early rate cut, but there's a downside too. So first up from Stuff on the 22nd of November, relief may be in sight for interest rates. Home loan borrowers who are concerned about rising interest rates may find some relief as financial markets are now anticipating a faster decline in interest rates than previously thought. The market currently projects approximately 3 interest rate cuts starting from the middle of next year. Gareth Kiernan, chief forecaster at Infometrics, attributes this shift in sentiment to the recent reassessment of the persistence of inflation. According to Kiernan, global inflation is expected to ease more rapidly than feared, as indicated by trends in wholesale investor rates from May to October. Chris Tennant-Brown, a senior economist at ASB, notes a significant decrease in long-term bond yields and swap rates over the past month. Expectations of further Reserve Bank hikes have also diminished, both locally and internationally, with global markets expressing confidence that central banks' policy rates have peaked. While ANZ has revised its forecast, anticipating the official cash rate to remain at 5.5% until the Reserve Bank is comfortable with a cut, Westpac remains the only major bank anticipating another hike. Kiwibank's chief economist Jared Kerr supports the market's expectation of 225 basis point OCR cuts next year, with consideration for a third cut. However, he cautions that the Reserve Bank may remain cautious until their next monetary policy statement in February. According to Kiernan, the evolving market expectations haven't yet posed problems for the Reserve Bank, as retail home loan rates continue to rise, providing additional tightening for the bank. However, he emphasises that the bank must be careful with its tone in the upcoming week's update. Any indication of lower interest rates or an earlier cut could be perceived by financial markets as an endorsement of the recent market shift, potentially pushing wholesale rates down further. Tennant-Brown adds that term deposit rates remain high and unchanged despite the evolving interest rate landscape. Topic number 2 from landlords.co.nz on the 21st of November, solving the rental shortage, new legislation and a change of attitude. The New Zealand Property Investors Federation plans to communicate with every member of Parliament in the new national-led government addressing the rental housing shortage. Unlike previous discussions involving government bodies and social housing groups, the NZPIF claims their insights have been overlooked. NZPIF Vice President Peter Lewis urges collaboration between the government, landlords and property investors to acknowledge and solve the rental supply issue. Lewis suggests that overcoming shortages involves changes in legislation and a shift in the government's attitude towards landlords. He emphasises the need to recognise landlords as essential contributors to society, proposing incentives and rewards for them to boost rental supply. The Federation attributes the decline in rental properties to actions taken by the last two governments, such as altering tenancy laws and eliminating the 90-day no-cause termination notice and the ability for property investors to offset mortgage interest against rental income for tax purposes. Private rentals constitute 80% of the market, with a growing number of individuals expected to rent for life due to housing affordability challenges. The NZPIF advocates for incentivising and rewarding landlords, asserting that penalising them with high taxes and increased legislation hampers supply. Lewis dismisses the idea of the government solely building housing, deeming it expensive and unsustainable. Despite the urgency to address the rental shortage, Lewis acknowledges the difficulty of rapidly increasing the number of rentals. He highlights the economic challenges faced by private individuals who invest in rentals, citing examples of uneconomical scenarios, such as an $800,000 Auckland house rented at $600 a week, incurring weekly losses of over $500 a week. Queenstown exemplifies the repercussions of the shortage, where a lack of affordable rentals forces workers into crowded or makeshift living conditions. Lewis notes that many landlords in Queenstown have withdrawn from providing housing due to financial impracticality. He emphasises that being a landlord is a business and not a charity, with costs associated with property ownership. Regarding potential policy changes, Lewis expresses scepticism around the removal of extra taxes imposed on property investors from April 1st, as outlined in ACT's election manifesto. So I'm sure that Peter will have been quite happy with today's announcement that we're getting interest deductibility back sooner rather than later. He speculates that political dynamics might influence such decisions, citing uncertainties around the removal of taxes imposed during the coalition government with New Zealand First. Want to learn more about investing in property? Join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband Paul Roberts via the website. Third topic for this week in review from One News on the 23rd of November, rental growth surges to double the long-term average, according to CoreLogic. National rental growth has surged to 6.1%, nearly double the long-term average rate as reported by property research firm CoreLogic. According to CoreLogic's November housing chart pack, rental yields have reached their highest level since late 2020, rebounding to 3.2% from a low of 2.6% in March of 2022. Auckland and Wellington have the lowest yields, both below 3%. CoreLogic New Zealand's chief property economist Calvin Davidson attributes the rental growth surge to various factors, including higher wages and a tightening supply and demand balance driven by increased migration in New Zealand. Despite the rise, yields remain relatively low compared to historical standards and other asset classes like term deposits. Davidson suggests that with growing rents and yields, along with potentially more investor-friendly tax policies, investor participation may gradually increase. Davidson notes that mortgaged investors currently account for only 1 in every 5 purchases, citing higher deposit requirements, low rental yields, and the absence of mortgage interest deductibility as deterrents. He anticipates potential shifts in investor behaviour following a change of government and the introduction of property-friendly policies. Additionally, CoreLogic reports the first increase in national property values in 19 months, signalling the end of the market downturn. October saw a 13% rise in property sales compared to the previous year, marking the 6th consecutive monthly increase. Despite a decrease in new listings, 9,012 over the 4 weeks ending November 12th, the market share for first home buyers remains at a record high of 27%, with Auckland and Christchurch at 29% each. which bucks the theory that it's unaffordable for first home buyers in the current market. So get out there if you're a first home buyer. Fourth topic for this week in review from Stuff on the 23rd of November. Here's where demand is rising fastest for houses. Realestate.co.nz has introduced a novel gauge of housing demand and market engagement based on user searches and property saves, aiming to offer more precise insight into the real estate landscape. The data reveals a consistent increase in searches and engagements per listing over the past 12 months, with a 1.9% rise in searches and a substantial 26.4% increase in engagements year on year as of October. Wellington led the surge in demand, witnessing a 47.7% spike in searches, followed by Waikato at 8% and Auckland at 6.4%. The engagements per listing also saw significant growth in Wellington, Bay of Plenty, Auckland and Waikato. Despite a September dip during the election, both searches and engagements rebounded in October. Gisborne, Otago and Central Otago lakes consistently displayed higher demand than other regions throughout the year, possibly due to low stock levels fostering increased competition. Central Otago and Lakes District and Otago recorded the highest property searches in October from individuals located in Auckland, indicating heightened competition in these scenic areas, potentially involving international buyers and those seeking second homes or holiday homes. The data aligns with a broader trend of growing interest in the housing market, providing a more substantiated perspective compared to speculative hot takes. Last but not least for this week in review, topic number 5 from One Roof on the 22nd of November, Tony Alexander, 119,000 reasons for an early rate cut, but there's a downside too. An additional 119,000 individuals need housing in New Zealand due to a surge in migration, primarily from China, India, the Philippines, South Africa, and the Pacific Islands. This influx, contributing to a 2.3% population boost, benefits employers by easing staff recruitment, but it puts downward pressure on wage growth, currently averaging over 7% annually, according to Stats New Zealand. The migration boom, while positively impacting the economy through increased consumer spending, raises concerns about strained infrastructure, including healthcare, electricity, roads, public transport, and water supply. The housing market also faces challenges, with potential upward pressure on prices worsening affordability. The rental market has experienced a notable shift, making it easier for property investors to find tenants. However, this has the potential to lead to rent increases, as we're seeing at the moment. The Australian experience with soaring rent growth and amid a migration boom serves as a cautionary example. As rents rise, there's a risk of increased pressure on young renters, possibly prompting let me say that again. As rents rise, there's a risk of increased pressure on young renters, possibly prompting property purchases or immigration. New Zealand has already witnessed a net loss of 45,000 residents in the past year. While the government faces little immediate pressure to curb migration, concerns about infrastructure strain may lead to policy changes in the future. The situation parallels developments in the UK and Australia, where growing pressure on the government to control migration is evident due to infrastructure and housing concerns. A potential backlash in New Zealand may arise as unemployment climbs towards 5% and housing affordability re-emerges as a significant concern, possibly around late next year. Although, to be fair, there's also a pretty good chance that interest rates will be starting to come down by then as well. And I would suggest that interest rates are the biggest cause for unaffordability at the moment in the current market. Successful property investing involves a combination of strategic planning, financial awareness, market knowledge, and risk management. If you want to hone your skills in these areas, join me at one of our upcoming free events called How to Succeed with Property Investing and learn more about it. As an experienced property investor and a financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors, as well as first home buyers, and I'll even tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our events. Alternatively, if you've already been to one of our free events, for example, you can book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. And if you're already a lifetime coaching client of ours, you'll already know that you can reach out to your coach for support at any stage that you want to. Thanks for listening.